Good evening, everyone. My name is Madalina Iacob. I'm a co-managing editor of That Wire North America, and I have the pleasure to interview this evening Michael Fisher, managing director in Apollo's Opportunistic Credit Group. Michael, I'm so happy that you could join us. We're the last interview. We kept the best for last.
Yep. Well, thank you for having me. I appreciate it.
Michael, you sit on Apollo's hybrid desk, focusing on secondary market investments, primarily in highly levered companies. Can you give us an overview of Apollo's opportunistic credit strategy?
Sure. So Apollo's got a very wide-ranging credit platform, as you know. We have private credit. Can you hear me okay?
Yes.
Okay, private credit. We have a CLO business as well, and then what I sit on is called the opportunistic or hybrid credit desk. And the strategy we typically employ is to look for companies that need some kind of bespoke financing solution. So sometimes that does mean distressed, where the bonds are trading well below par, and we want to come in and provide liquidity and perhaps follow on capital. A lot of times it's not necessarily a distressed investment, but a secondary, it's a private credit solution that just requires something different than a public market solution would allow. So whether that's call protection structured for a specific purpose, or maybe PIK flexibility or something else, covenant flexibility that they can't get through a regular way high yield financing, we can come in and provide that. And a lot of times we'll try to pair that with a secondary market transaction as well. So if there is a security in the market that we see will be a beneficiary of some transaction, we may put a position on in advance and then go talk to the company and say, we see you have an issue, here's our potential solution. And then we see if it kind of works out. So it's sometimes is a combination of secondaries and primary, and sometimes it's just one or the other.
So what drives time allocation and investment philosophy for you?
So I think it's different for everybody on our desk. For me personally, I tend to shy away sometimes from pure valuation bets that are just dependent on what's going to happen in the future. As we can see today, it's almost impossible for anyone to predict how many cars are going to be sold 5 years from now, and to predicate a trade simply on that would be difficult for me. So I try to find situations where I think I can bring something to the table because Apollo has capital that's different from the market, or because we see something in a covenant or a structure that is maybe differentiated, and then we pair that with a valuation approach. There's other times where valuation does lead. We have a great private equity franchise as well, and sometimes we can draw on those resources and experiences and have conversations that allow us to have a differentiated view. So it's really trying to pick a spot where I think I can do something different rather than just kind of guessing on future auto sales or future chemical sales or something like that.
So, you talked about the current state of the market and how hard it is to predict what's going to happen. How has the over-changing tariff policies impacted your investment strategy?
So I don't think it's changed a lot because, again, we're not trying to predict the future.
Yeah.
I think one thing we're thinking about is just the impact of this timeout on all business transactions, how it's going to have both on the capital structures and the businesses themselves. So from a business perspective, we're obviously hearing about the number of ships sailing from China to the U.S. and how there's a pending shortages, and that's going to drive up costs for specific industries, and we can kind of try to build that into our models and our valuation. But for companies in the high yield world, they always have to be cognizant of whether they have market access, which is why high yield companies should never wait till the last minute to refinance. They should be thinking about their capital structure years in advance, because if something happens, they're not going to be able to necessarily tap the markets the way an IG company would. So I think we're seeing a lot of companies where if they waited too long and now they have another 6, 12 months they have to wait for the markets to clear, it's going to put them in a situation where they need to maybe think a little bit outside the box on how to refinance their debt structures. So I think we're going to see a lot of that.
So I know you're focused more on the chemical sectors and packaging. Do you see specific pressure points in these sectors that you can talk about?
Yeah, I think it's different for chems and packaging. So for chemicals, I think it's an interesting situation. This is my take, not necessarily the Apollo house view. But even if you go back to beginning in 2018-19, we had the Chinese property market correct.
Yes.
And, some would say collapse, probably collapse. And since that time, there's been an overcapacity situation in chemicals. We had a little bit of a respite post-COVID where there was a demand spike, and companies made windfall earnings for 2021, 22. Now we're kind of back to a demand problem, and it's possible that is still a layover from autos peaking in 2017 and Chinese property peaking in 2019, and it's unclear whether the COVID blip was just a blip in a long-term secular decline. So I think there's a lot of people in chemicals questioning long-term valuations and what the demand picture looks like. Are we in the middle of or the seventh year of a deflationary trend rather than kind of a typical cycle? So I think chemicals are going to be interesting for that reason, and we were seeing some pretty low valuations on businesses, maybe through what we would have thought was a cyclical trough. Packaging's, is different. It was supposed to be stable. If you went back to the GFC, packaging volumes went up, and there were earnings problems. But from a volume perspective, packaging was always considered to be a very stable industry. Now that kind of VAR model is broken because we had this enormous volatility driven by COVID. So businesses that were supposed to be stable now, with the last 5 years of modeling, look incredibly volatile. So valuations are being impacted that way. Now I don't think there's a secular problem, but it's certainly more volatile than we thought, and that changes how much leverage you can put in these companies.
And I think that has an impact on other industries that depend on the chemicals, especially now with the tariffs. I think that brings another layer.
Yeah, I think downstream buyers of chemicals are going to possibly see inflationary pressure, but I think the markets these are, for the most part, global commodities, and the products are fungible. So although you may try to put a tariff on one country or another, I think we'll probably see trade routes figure that out, and the full brunt of the tariff won't necessarily wind up where it's intended. So I think ultimately, it's a demand question and what the tariffs do to the overall macro environment. And from a chemical, most of this stuff is derived from oil ultimately. So we've seen oil prices come down dramatically. So I think that is kind of a counterbalance too.
Now, if we take a broader look, you talked about how higher companies shouldn't wait, right, until the last minute to refinance their bonds. What's your market outlook given the tightening credit conditions and the volume of that coming due in 27, 28?
I think we're generally speaking, tend to be a cautious firm, and I think that certainly is where we are now. I think, in the past cycles like this, we've seen a lot of Fed activity, and I think the difference here is the inflation story. And it might tie the hands of the Fed and their ability to react the way they did during COVID. So I don't think that's saying anything, earth-shattering. But I think this time could be slightly different because of you may not have the Fed backstop that we had in the past. So I think we're, trying to find specific situations where we would feel comfortable, even in extreme scenarios for the macro environment.
Even like extreming, like a recession, or
if there's a recession, we're trying to make sure we have dry powder. At least personally, when I'm thinking about investments, I want to make sure that the money I'm putting to work is going to work in all kind of macro environments, because I think the range of outcomes is really wide. And that's kind of how I try to solve for it, is I try to think about and make sure that whatever I'm doing my confidence interval is wide. I'm not trying to be overconfident in what I can predict about where we're going to go.
Interesting. Now, if we move forward, there's been so much talk tonight about LMEs, liability management exercises. In the wake of CERTA and Mitel rulings, have your views on liability management exercises evolved or changed? Are you seeing meaningful changes in documentation, in lender coordination, or in sponsor behavior?
It's still a little early to see how the market's reacting to those specific transactions. I think from the advisor community, I think there are some very clever lawyers out there who right away are figuring out ways to pursue the same effective outcome, despite the Mitel ruling, despite this sort of ruling. So, documentation matters. Those decisions were very specific to documentation. So only a certain part of the market's going to be kind of ruled out through the CERTA transaction. And even for companies where their documents might be slightly tighter based on that outcome, I think there's clever lawyers out there who will figure out ways to pursue LMEs. I think overall, I think we've heard this a few times tonight, is the LME threat, I think, is evolving more as a stick to encourage a more consensual deal rather than, the end in itself. So I think the market was kind of going that way already, and so I'm not really sure whether those decisions will change that trend. I think for people like us, we participate in a lot of these transactions, both in new situations and in situations where we're already invested. But the LME is not the goal. The goal is to try to provide capital to the company in a responsible way. We're not necessarily trying to do a non-pro-rata deal. So in order to encourage consensus, sometimes those kinds of strategies are helpful. But the goal is consensus, I think, for most people, especially the larger firms like ours.
And this, I think, it's a good segue into co-ops, right? Because groups are forming much earlier now. And when you're involved in an LME, what drives your decision to join or not a co-op? You just talked about, non-pro rata LMEs. That's not something that you prefer. But.
So it's very situational dependent. We were involved in one last year where we were a fairly large lender, and there was a co-op that we decided not to participate in. And it was because in that particular situation, we thought there was a financing solution that would pay everybody par, and therefore we didn't need the permission of the existing lenders because they were going to be paid off in the transaction, and there was no defensive need for a co-op because we thought that we could provide a situation where everyone got paid what they deserved. So everyone got the bargain of their benefit of their deal when they bought the loan. So I think in situations like that, we would rather kind of play the free agent role and provide new capital than necessarily always be in a co-op. In another situation where we're worried that the lender is not necessarily being cooperative, or we're kind of worried about the group dynamics, or there's a lot of crossover holdings, I think that is where co-ops can come into play. And I think our bias is to partner with other firms and make sure we're all getting the same deal, rather than make it a free-for-all. So I think in general, co-ops do make a lot of sense, but there's also situations where, because we're looking to provide new capital, it's not necessarily the right play for us.
And sometimes it binds lenders together, and then the company cannot really. We saw in Bausch, it was a similar situation, but then Bausch turned out to be a great situation. They refinanced, they got $7 billion in new money, but the co-op was there 90%, and they couldn't do anything, like no deal before.
And I think it's one thing to hold the sponsor or the management team to the documents and what was intended, and another thing to be obstructionist. So again, for us, we're trying to partner. We view the people we're lending money to as our clients in many respects. So we're trying to partner with them. So we're not, if we're involved in a co-op, that's certainly going to be the direction we're pushing a transaction towards. Is not necessarily to be obstructionist, but at the same time, we have to defend our capital, and we don't want to be on the wrong end of a liability management exercise. That's certainly something we're always trying to avoid.
Right. And I'm curious, you talked about one situation where you opted out of a co-op and you gave the company capital, direct capital. How did you structure that investment? Why did it make sense for you to stay out and go directly? I mean, you just called the CEO, the CFO, or the CEO and said, we want to offer you this, or?
Yeah, I mean, I think we try to, in situations we're involved, and even if we're not involved in just watching it, it's my job as the analyst to try to be on the phone with the CFO as often as possible, and just making sure I understand their business, I understand his or her needs and what the financing needs might be coming up, and then to make sure people are aware of what we're looking to do and how we're looking to deploy capital. And I do think it's helpful for even if they raise money from somebody else, I can be helpful in explaining what the range of outcomes is. I'm sure they're getting a lot of people talking in their ear, but we're actually deploying the capital. We know where the market terms are. We know what the market's going to require, and maybe we get outbid in the end of the day. But I'm still trying to partner with companies and make sure that they know that we're potentially an option if it's appropriate. So in that situation, there was a process ongoing. So the company was in the market for money, and we chose to try to engage directly rather than just go through the co-op.
And I'm curious if you see now more private capital kind of stepping in and helping companies as the BSL market has closed. I'm just curious if there's more need for this type of situations where you just step in, you get more calls, from companies or sponsors. Or is it kind of expensive? I don't know. I'm just curious in that as well.
I don't think it's expensive. I think that the market's competitive. Ideally, you're getting paid a little bit more than the underlying fundamental risk of the company, but you're being compensated for the complexity of the transaction. So I think it is competitive. It's not the money that's going to work, even in these stressier situations, is not necessarily making hundreds and hundreds of basis points more than you would get for the underlying risk. But they're complex, so the market of firms that can provide large checks in those situations is a little smaller. I think. Yeah, that's what I would say. I would say it's competitive all across the board.
So it stays competitive and now with the volatility.
I think so. And again, I think our strategy, or the way I kind of approach the world, is it is a competitive market. I'm not going to win because nobody thought of an idea and because the CFO didn't pick up the phone and market check whatever I'm offering. I'm going to win because I'm user friendly and providing a document that serves their needs and provides kind of a fair cost of capital, and that's good for everybody, and that allows us to continue to partner down the road.
When you look at your documents, you include all the protections that you're afraid of.
That's the one thing that we're very clear about, is that this isn't
going to happen.
This is not going to happen to us. So if there's in the situation you mentioned, the existing document was wide open, which allowed a creative solution to come in, and once it became clear to the market that creative solution was going to work, that forced a consensual transaction. because it made sense once everybody
Meaning like a
realized.
big co-op or
It became a consensual deal across the entire capital
I get
structure.
it.
So the co-op group ended up participating in the deal, and it was kind of a win-win because it became, once it was obvious that the deal was going to happen with or without, the company was not going to file for bankruptcy when it had a financing solution on the table, and then that kind of forced a consensual deal. Now, when we're drawing up those documents, we're willing to provide flexibility around call structure and pick flexibility and some other things the company may ask for. But one thing we're pretty, we try to be very careful of is that we're not kind of the next target of an OMA.
So what are you? So just the typical ones, right? The blocker, the Chewy blocker, the SERTA blocker.
And I think
you have your own lawyers, obviously,
we
working
have our
on
own lawyers,
that.
but I think I think the language in some situations is starting to try to be a little more general. That says nothing to the effect of, or something for Chewy, it has to be for bona fide purposes. For J.Crew, same thing. So you have language in the document that, regardless of whether somebody catches some small nuance, you'll have some basis for litigation. And I think just the basis for litigation is often enough for companies to try to avoid those situations. Because I don't think any company really wants to end up in a litigation down the road. I think that's a bad outcome. So we're trying to write documents that always preserve our rights if something goes wrong to come back and make the argument.
And we talked about co-ops and group formation. And I asked this question earlier. I'm just curious, how do you see the smaller lenders in the stack, right? You find yourself usually in holding big positions and you can control the structure of an LME or of a deal, or you can even step out and say, I'm going to provide the money myself. But what would what would be your advice to the smaller lenders who are trying to protect themselves in LMEs when they're non-participating parties?
I worry about it too. Like, when you're building a position or anytime you're involved in something, you never know. So I do worry about it too. So I sympathize. But I do think, in general, and this is kind of a broader comment, is your investment strategy always has to fit your capital base. So if you have locked up capital for 10 years, that allows you to do something different than if you have capital that can be pulled on you every 3 months, or before you have to get your investors. So I think, in general, that's a good rule, is that your investment strategy will fit your capital. So if you're a smaller fund, that does create different kinds of risk when you're involved in a large cap situation. So that can be good and bad. If you're smaller, you can be involved in much smaller situations, and they can be impactful to your returns. Or if you're Apollo, a $300 million term loan is not something that we're really going to look at because it may not move the needle for us. So I think picking your spots is probably the best answer. I don't think there's any silver bullet. If you're going to own 20 to 30 million of a big term loan and the largest lender is in the business of non-pro rata LMEs, that's a problem. So you better pick your spots. I don't think there's any way to necessarily solve that through documentation. I think it's just making sure your investment strategy fits the capital base.
And you told me you view capital solutions as partnerships with lenders or companies. Why are you so much against non-pro rata deals?
Well, I just think it's kind of more expensive and bad for the market over the long term, because I think you're trying to price the risk and volatility of the earnings, and once you're having to, if you don't know what you're buying because you don't know what this capital structure is going to look like if something goes wrong, that's obviously going to increase the cost of capital all around. So I think that's not something that we're in the business of doing. And I think, again, we have to protect our LPs, and I can never say never, but for the most part, when we're investing in a loan, we're assuming that we're on equal footing with everybody, and we're making the investment on that basis. And we'd rather be right or wrong on that basis than find something out of left field that completely upends where we sit in the capital structure. So I think, in general, we're trying to, either through co-ops or through documentation, setting the table for a kind of a fairer playing field. I think that works better for us. We're obviously, it's a large firm. We have a lot of capital deployed. We have a lot of partnerships in the market. It's a repeating game. We're seeing the same sponsors. We're seeing the same other lenders over and over again, the same set of advisors. So I think if we were to try to pursue situations that are non-51%, I think that necessarily wouldn't be long-term accretive to the strategy
that you guys have, right? Interesting. Also, it seems like it's not your strategy necessarily to own the company via that for equity swap in Chapter 11. Earlier, one of a lender that I interviewed earlier said that they definitely don't want to be involved in a Chapter 11, and it seems like it's changed. I started covering this market in 2010. It was all about Oaktree, Appaloosa, Elliott, Elias. They were all going for the fulcrum security valuation, unsecured bonds usually, second lien. The loans were never the fulcrum, and they always wanting to own the companies via the bankruptcy, the Chapter 11, and they do a rights offering and the post-reorg equity with trade. What is happening right now? Is there a harder market to trade post-reorg equity? And I know Chapter 11 is more expensive,
Yeah.
but why is everybody pulling back from
I
that?
think the number of situations where the exit kind of goes smoothly have been few and far between. I mean, PCG was a story where the equity rode through and turned out to be a good investment. But I think the risk of getting caught in a illiquid post-reorg equity where it's too small for an IPO and you can't find the right strategic, I think is something that everybody is worried about. And I also think, again, for us, it's not a four-letter word to wind up in a post-reorg equity, but it's usually not our base case or our plan A, partially because the number of things that have to go the right way for that to work. We have to have the time to do the proper due diligence. We're going to look at it like a private equity investment, which is not just buying something puts us down 10 points. It's a real due diligence underwrite. And then we have to have a situation where there's liquidity to build a position. And we have to obviously like the situation and be willing to take on the workload of maybe hiring a new board, hiring a new management team, operating it for a couple of years before it's ready to be exited. So I think it's just a hard situation to find where everything lines up. If we see it, it's not something that we'll completely shy away from, but it's not normally planned out.
I think before we wrap up, I want to talk to you about, let's call it a case study, ARDA, right?
Yep.
In this situation, I mean, the company is facing some issues now, but you at least came to the company in 2025 with a solution. Mm-hmm. You offered them a new secured financing to address the maturity.
Yep.
And
their first maturity was maturing this year in 25.
So I'm curious, what made this deal attractive to you, and how did you structure it? To balance the risk and the return.
So I think this one is a good case study, and for a lot of reasons. So we did not have an existing position in the company, which is something I don't think people realize, and I think that I've heard people tonight talking about the deal away and doing a deal with the existing creditors versus a third party, and most of the time a company will choose to partner with its existing creditors. In this situation, the mix of existing creditors is pretty complicated. There's a lot of crossover holdings. There were people with different securities, had different motivations, and I think what we thought the company really needed was time to try to deal with that situation, and what we could offer was a clean, fair cost of capital. So most of the people, I think, approaching the company with ideas about a 25 refinancing were marrying it with some quid pro quo. We'll give you new money, but you got to roll up our existing 26s or our 27s or PIK notes or something else. And we didn't have anything to trade.
Any agenda, in a way.
We just said, we're not going to try to charge you 15%. We're going to give you a fair cost of capital. We can move very quickly. We already have a structure figured out. So when we walked in, we said, here's the structure we think works. We've done our homework on that. And our ability to act without any baggage, I think, was extremely helpful. And the company could take the money, refinance the 25s, and then leave itself time to deal with the rest of its capital structure, which is what it's trying to do now. And I think the third-party deal a lot of times gets a bad rap and people get annoyed about it. And I got a lot of phone calls after that deal was done. But then I explained, I said, nothing's happened here. The existing 25 bonds at the time were trading at par. And everybody knew that. So people knew that one way or another, there was somebody getting par.
There was expectation. The trading was telling us that they will be taken out.
They would get taken out. Now there's another security, which is ours, which I believe will eventually get par. And that's no different than what was happening before, just because the structure and the maturity date is different. The financial impact on the rest of the capital structure is the same. And, again, from other people in the structure's perspective, what would have been bad is if we had put in a 20% cost of capital with an enormous make-whole. Right. Then there would have been real value destruction for the rest of the capital structure. We didn't do that. Our cost of capital was pretty reasonable. And therefore, maybe somebody would have liked it to be 50 basis points cheaper, but that's not a lot of leakage in the context of the ARDA capital structure. So I think it was, I do believe that it was actually a win-win-win for the existing capital structure. We get to put a little money to work, the company gets more time, and we're not pulling a bunch of resources out of the business when they don't need that to happen. So I think the fact that we were able to do it from a third-party perspective actually worked out pretty well for everybody. I tried to explain that, so I don't know if everyone believed me, but I think that's how it's going to work out.
We have you now on the record.
Yeah.
Well, before we wrap up, I guess I just want to ask you a quick personal question. What do you like to do in your free time when you're not providing capital solutions?
Well,
what are your passions?
I don't know. how much of that there is. I have 4 kids, so that takes up that takes up a lot of time.
I have 2, so I know.
Yeah, exactly. Well, I always joke that having kids is like a gas; they fill to expand any space you put them in. So whether you have 2 or 4, they're still going to fill up to take up your entire life. So I don't think there's much of a difference from time allocation. And then I'd like to try to keep healthy, exercise as much as I can.
You're running, or
Yeah, and I always I try to think this is I was trying to think of something to respond to this, and what I try to do is I just had a birthday. Every year I try to think about what's one change health-wise I can make, so that I can, if I keep that up for the rest of my life, the next year I extend everything by 1 year.
Wow.
So this
Can
year,
I ask you what was your resolution?
This year's water. So this year is like drink more water.
More water.
If I drink more water every day for the rest of my life, do I get to extend the amount of time that I spend in reasonable health, hopefully.
It's very good. It's very good for your skin as well.
We'll see.
All right. Well, thank you so much. That's great. That's such an interesting resolution. I never thought like every year to have something that's gonna.
I don't stick with it, but I try. So.
Well, here you go. We have the water here.
Thank you very much.
Thank you so much.
I appreciate
It was great talking to you.